Students, happy and good morning to you all. Thank God for the new day. I pray that God's grace be upon us and keep us all safe and protected during these difficult times. Students, take supreme and sovereign care of yourself and perfectly follow the instructions of your dear parents and help your parents feel most joy in their life. Students, I greet and welcome you to the class on commercial applications. Stay focused and grasp the concepts with first class fineness. Make sure that you write down the additional points which I stress and repeat for easy understanding and good performance. Stay focused and be committed to do your good work, children. You must utilize the previous learning to promote the new learning. Thank you. Thank you for being very smart and brilliant. The learning objectives for today's class are as follows. We are into the chapter of finance. We have taken the first unit as GAP, generally accepted accounting principles. Under that, today we are going to take up the important principles of accounting. There are about 6. Historical principle, historical cost principle rather, matching principle, materiality principle, disclosure principle, consistency and conservatism. There are about 6. You should know at least 5, children. Yes, important from your examination point of view. Then we'll move on to the next unit of the chapter on finance. The next unit is financial accounting and reporting. Under this, you're going to study about financial accounting and reporting of only non-trading concerns. Very important. So, what are non-trading concerns? You know, they are opposite to trading concerns, business. Their motive is not profit, all that you know. You have studied in the previous standard. Yes. Then meaning of non-trading concern. Yes. Then final accounts of non-trading concern. Under that, you're going to study about 3 detail. Here, you're not going to prepare any accounts, children, but you should know how to prepare the accounts. The steps involved or the tips involved in preparing account. First one, such as receipts and payments account under non-trading concern, income and expenditure account under non-trading concern, and balance sheet. Balance sheet under non-trading concern is considered as statement of affairs. I will teach you the steps. Next one would be the steps in preparation of accounts. First, we'll take up preparation of receipts and payments account today. Recapitulation and review exercise will be done accordingly, children. Yes. Now we'll go to the first important learning objective is important accounting principles. First one is historical cost principle. Cost is expenditure. Historical means what has taken place. Expenditure which has actually taken place is called as historical cost. What is that? Expenditure which has actually taken place is called as historical cost, and there's a principle. Principles are nothing but guidelines. So you should know. Let me read out for you and I'll tell you the additional points to make it very easy. Historical cost is opposite to fair market value. Please write down, children. Historical cost is opposite to fair market value, and this is original cost of an asset. So original cost of an asset, we call it as historical cost. Historical cost refers to the cost incurred at the time of acquisition. What is acquisition? Buying, purchasing, acquiring. This principle is the basis on which the assets should be valued. That means the actual amount spent for purchasing assets after taking away the depreciation value. Yes, assets are in use, children, and every year they should charge depreciation because of the use of the assets. So what happens now? Every year the assets become little old due to the usage. So they're going to charge depreciation. There are various methods of depreciation. Company will adopt their own depreciation methods and they will value the assets. Assets are recorded in accounting as its exchange price. What is exchange price, children? Is nothing but historical cost less depreciation. Always assets should be valued with historical cost less depreciation. Why? Because every year the assets become older and older later. Cost can be verified with reference to documentary evidence because there must be a bill or something like that to show that expenditure has actually taken place. Please write a few more points, children, for you to understand this well. Assets are recorded in the balance sheet at their historical cost. What is historical cost? Already I told you, children. Historical cost is nothing but the actual cost on which the assets are purchased, actual cost which has taken place. Now, here one more point you can add, children. All goods and services purchased by a business must be recorded at the historical cost. So all purchases of goods and services should be recorded at historical cost. For example, children, historical cost of an office building, let's say, was about 10 million when it was purchased 20 years ago, but its current market value maybe 3 times, 4 times more than that. Yes, sure, you all know that. So we always go by the historical cost. This principle is important, children, to for the people to read the balance sheet or in analyzing the of the company, books of accounts of the company. So historical cost is very important because it's the actual cost which is incurred or spent at the time of acquisition of assets. Second one is matching principle. So you're going to match one with the other. What is the one? What is the other? One is the revenue, other one is the expenditure. So we've got revenues and expenses. What are revenues? Smaller incomes. So let us see. The expenses incurred in an accounting period is matched with the revenue income received in that period. That means what? Getting to know the net profit or net loss happens when you go by matching principle, adopting matching principle when you record accounts, when you keep books of accounts. Adjustments are made for prepaid expenses. You know what's prepaid expenses? You like prepaid charges, outstanding expenses which are yet to be paid, accrued incomes, accrual basis. So I'll tell you what is accrual basis and explain to you. And revenue received in advance. So you got prepaid expenses, outstanding expenses, accrued income, and revenue received in advance. Then you got proper allocation of capital expenditure into different accounting periods for matching relevant income and expenditure. Three things happen here, children. You're going to match the revenues income with the expenditure. When you match the income with the expenditure, you're going to make some adjustments in case of 4 or 5 important items of accounts: prepaid expenses, outstanding expenses, accrued in revenues, I'll explain, and revenue received in advance. What is advance? Before itself, we're going to receive the income before the transaction take place. Proper allocation of capital expenditure. Capital expenditure is huge expenditure incurred one time, huge amount, into different accounting periods for matching relevant income with the expenses. So I'll tell you, please make a note, your children. Revenues, income should be recorded during the period in which they are earned. Always. Even expenses incurred during a period be recorded in the same period in which the revenue were earned. Then only we can match the revenues with the expenditure. Again, I tell you, revenues and expenses, or income and expenses, should be recorded during the period in which they are earned, which they are incurred. This is followed, children. This is followed by accrual basis of counting and adjusting entries. So accrual basis means, please make a note, your children. Accrual basis means, or accrued revenues mean, revenues and expenses which are recorded when transaction occurs rather than when payment is made. So you must understand this, children. So accrual basis of transaction means revenues and expenses are recorded when transaction occurs rather than when the payment is made. Soon after the transaction, it will be entered in the books of accounts. Payment is not a matter for accrual basis. So that is why we need to go for adjustments. For example, I tell you one more thing, children, please make a note. If 1,000 crores worth of product sales is earned in November, for example, the company will pay then rupees 10 crores in commission in December. Let's say we have to pay 10 commission in December. But the matching principle states that 10 crores worth of commission should be reported in November itself along with November product sales. Have you understood, children? Yes, I know. So what is matching principle? Matching principle is nothing but you're going to match the income with the expenditure with proper adjustments to be made. Adjustments are carried in terms of prepaid expenses, outstanding expenses yet to be paid, accrued revenues, I told you, and revenue received in advance. On accrual basis, you're going to record the transactions immediately when they occur rather than when the payment is made. The next one is nothing but materiality concept. Materiality. So you must understand what is materiality in little terms, children. Anything which is significant of value. Anything which is significant of value is called materiality. Material, immaterial, we say. So materiality. Here, what is materiality? Quality of being significant and relevant. Anything which is of quality and significant and relevant has got material in it. So items that are, please make a note, children, items that are important enough to matter are material items. In accounting, everything is important, but there are most important items also. We call them as material items, materiality, which is of great significance and relevance. So materiality means the significance of information to the user's decision. All items that influence decision of the user should be disclosed in the financial statement. Time and money should be wasted recording matters of less importance. Should not be wasted. So time and money should not be wasted in recording matters of less importance. Please add a word, not wasted. Only the significant information is to be disclosed, disseminated, or passed on in the financial statements. Children, you must understand disclosure of everything that is important to report the audience. Who are the audience? Users. Users, in company children, it starts from government, it may be creditors, suppliers, employees, tax payment, even the media people. Everybody should know. These are the users of financial reports. So here what happens, whether the information is material, relevant, what is material children? Material nothing but relevance and significant. Whether the information is material is a matter of judgment. So the decision makers will have will differentiate between material information and immaterial information. So time and money should not be wasted recording matters of less importance. Yes, this concept, children, helps company to filter through which management sifts information. So what is important, they will reveal, and what is not important, they will not reveal. So materiality is maintained. What is materiality in accounting? It's nothing but significance and relevance of financial information. The main aim here is to make sure that the financial information that could influence investors' decision. So anything which can influence the investor decision will be disclosed. Next is consistency principle. Consistency, very important for comparability. You can compare accounts only when you consistently do the accounts, consistently following the same pattern, same methods of accounting. Accounting practices should be uniformly followed from one period to another. This consistency helps the management to take uniform business decisions and eliminates personal bias, prejudice, personal opinions of the accountant. It ensures better and effective comparison of the financial statements on year-to-year basis. Business units should use same principle, this is very important, same principle and methods consistently from year to year. So what happens, children? I told you earlier, please make a note here. Consistency is very important for comparability of accounts. Once you adopt an accounting principle, children, or method, it must be continued to follow it consistently. You must continue it. For example, I'll tell you one more thing. Being consistent with the policies, plans, and agreements, objectives of the is very important, children. Very important for the organization, because when we get in conflict with them, organization will suffer a lot. So once the policy, program, plan of action is made, you must stick to it consistently. So accounting must be done in the same way from one accounting year to the other accounting year. This helps the investors, children, and other users of financial statements to easily and correctly compare the financial statements and make the right decisions. What is personal bias? The personal opinion of the accountant may be wrong or may be false. It's all kind of eliminated by following the consistency principle. So I told you, being consistent uh, with policies, plans of action, programs, objectives of the organization, it's very important, and they should not be in conflict with each other. Next is conservatism. Conservatism is nothing but, please quickly write a note, children, doctrine of prudence. Prudence means cleverness, playing safe. Please write here, children, conservatism. You got a caption called playing safe. You're going to play safe. Yes, I'll tell you. So, what happens here? Conservatism principle. Revenue should be recorded in the books of accounts only when there is a reasonable certainty of the realization. What is realization? Actualization. Actually happening is called realization. Provision should be made for all the possible losses and liabilities. First, you make provision for losses and liabilities. Gains and assets will be taken care. I repeat, once you are very alert and cautious about losses, profits can be made easily. Accounting need to follow the cautious approach. Cautious, please keep a note, children. Cautious and intelligent approach, and use the method in accounting which is less optimistic. What is the meaning of optimistic? So you must understand, whichever is very close to pessimistic, you must avoid. So whichever is less optimistic, you must avoid. You must take care of them. You must be cautious about them. So I told you earlier, conservatism is nothing but doctrines of prudence. Prudence is nothing but cleverness with wisdom. Not extreme wisdom, but wisdom wise. People being wise, playing safe. So what happens here, children? Please make a note. Recognizing expenses and liabilities as soon as possible when there is risk is very important. At the time of liquidation, this happens, children. So preparing accounts with cautious and verification. Caution and verification is very important. You cannot just prepare accounts. Accountants, the work of accountants are very, very tedious children. They must take utmost caution, and they must put every accounting to verification before they submit the information. This principle is concerned with the reliability of financial statements, children. So you must, what you should do here, you must first of all anticipate possible future losses, and but not future gains. So what you should do, you should anticipate. You must be very uh, worried or cautious about the losses and gains. Profits will be taken care. So this principle, conservatism principle, please make a note, your children, helps to understate that rather than overstate the net assets and net income. So this is what I told you, children. I've written that caption called playing safe. Playing, P-L-A-Y-I-N-G, playing safe. What is the meaning of that? Here, this principle helps to understand or to understate rather than overstate the net assets and net income. And therefore, what we do? Therefore, we play safe. So what happens here? Losses are recorded first before the gain. Profits are registered when they are fully realized. So we first record the losses before gains. That is what it means to say playing safe. So we're going to understate rather than overstate the net assets and the net income. This is very important. There are 5 principles you have studied, children. What are the 5 principles you have already gone through? Historical cost method. Then we have seen matching principle, materiality principle, consistency, and conservatism. So we'll move on to the next concept, financial accounting and reporting of non-trading concerns. Financial accounting and reporting of non-trading concerns. So we are going to focus on final accounts of non-trading concerns. So what are non-trading concerns, you know, children? What are final accounts? First of all, I'm going to break this and explain it to you. Final accounts are nothing but accounts prepared by an organization which is done at the end of the accounting period. So accounts done at the end of accounting period is known as final accounts. Non-trading concern. This word is very familiar, like non-governmental organizations. Organizations not engaged in trading business activities are known as non-trading concerns. Here what happens, they are not for profit, but for some charitable, religious and educational purposes. Non-profit making entities exist mainly for the betterment of the society. That also you know, children. So these organizations are mainly meant for the betterment of the society, offering services. So the revenues, donations and grants from the public and government all help them to run. They are not depending on profit. They are not manufacturing anything. Here the management is responsible for the accounts also, children. So I told you what is final account. Accounts prepared at the end of the accounting period of non-trading concerns. The meaning of non-trading concerns, you know. One more point you should know before I go on. Final accounts gives an idea about the profitability of finance position of the business to its management, to the other owners or other users of the financial information. This refers to company's ending account balances used to create financial statement. Financial account reveals the results of business during a period. So you must understand, children. Not only that, final accounts highlights both financial position and profit of the institution. Here we call it as institution because it's not an organization which deals with trading or business activities and not for profit motive. So let's see. Final accounts are summaries of financial performance of an organization during accounting period and its financial position at the end. So you're going to find out the financial position of the company at the end only through preparing final accounts. For you to prepare the final accounts, you have seen the accounting cycle. Final statements is the end. Before that, you must start with transaction, journal entry, postings, journal entry, preparing trial balance, and then coming to the final account. So much of work is there. So you must understand, final accounts are prepared in order to find out the financial performance of the organization and the net result position of the transactions carried on in the organization. Final account represents three statements because we are not talking about non-trading. Only you have to talk about three important accounts, statements called receipts and payments account, income and expenditure account, and the balance sheet. Here we don't call balance sheet as balance sheet because it is of non-trading concern. We call balance sheet as statement of affairs. What is balance sheet also called as? Statement of affairs. The information contained in final accounts are used by various interested parties such as management, creditors, customers, investors. See, these are the users of financial information, children. I keep using the word users of financial information. See how many field of activity people require information: management, creditors, customers, investors, employees, government, etc., for their decision making process. Profitability, solvency, and prospect of the future of the organization can be assessed by analyzing by the analysis of final accounts. What is profitability, children? This I have already referred in the previous section also. What is profitability? It's nothing but the degree to which the business yield profits. The degree at which the business yield profit is called profitability. Solvency. Solvency is nothing but ability of the organization to meet the debts and financial obligations. That is called solvency. Insolvency, I told you, pauper. Solvency is the ability to meet the debts and financial obligations. Prospect is future. So I told you, children, final accounts, I can give the summary again. Final accounts gives an idea about the profitability of the financial position of the business to its users. This refers to the company's ending account balances used to create financial statements. Final accounts reveals the results of the business during a particular period. This highlights both financial position and profit of the organization. So you should now move on to the next learning objective, meaning of non-trading concern. Already I've told you the meaning of non-trading concern. I'll just give the meaning, children, today. Let's take up the meaning of non-trading concern. Stay focused, children. Non-trading concern. Non means not. So those organization concerns which are not engaged in trading activities are called as non-trading concern. So what are non-trading concern? Again, I repeat. Those concerns, those organizations not engaged in trading activities are called as non-trading concerns. Here, earlier I told you, children, these organizations are non-profit making entities which serve the society. They offer services, and community, individual institutions are there, like education institutions with activities other than trade. There's no trade. There's no production, selling, all that happen. No. We don't involve in production and things like that. But we are only here in this, we are only serving the society, offering services. They do not exist to make profit, children, but to provide voluntary services to the public. Organizations that do not set out with the prime objective of making profit is known as non-trading concern. These organizations are formed to promote art, culture, religion, education, etc., to build up the society, community. So you must example sports and social clubs, art societies, professional institutions, students associations, etc., or even hospitals, libraries, colleges, schools and colleges, all come under this. Why, children? Such organizations receive income from the donations, financial assistance of the government, income from members, subscription fees. Only these are the main source of income for them. And management is responsible for keeping accounts. So organizations which are not engaged in trading activities are called as non-trading concerns. So what are the final accounts prepared by non-trading concern? What is final account? Again, I'm telling you, children, accounts prepared at the end of the accounting year. Final accounts of non-trading concerns are three: receipts and payments account, income and expenditure account, and a balance sheet. So what is the other word for balance sheet? Statement of affairs. Children, before I close, I'll tell you once again. At the end of the year, non-trading concerns also prepare accounts in order to safeguard money of its members and general public from any misuse and misappropriation. So they should keep accounts. They cannot say, just like that we are spending. No, nothing like that. At the end of the year, they have to prepare accounts in order to safeguard money and its members, even general public, government money, from any misuse or misappropriation. And children also, it is important to know the total receipts and total payments, financial status of the institution. So the first important accounts prepared under non-trading concern under final accounts is nothing but receipts and payments account. I'm going to take the receipts and payments account. It's a real account in nature. In the next class, children, owing to time, let me quickly summarize what all we have studied today. We have seen the importance of accounting principles. There are 6: historical cost principle, matching, materiality, consistency, conservatism, uh, all that. Next, we have seen the financial accounting and reporting of non-trading concern, meaning of non-trading concern, and the final accounts. I just named it for you: receipts and payments account, income and expenditure account, and the balance sheet. I'm going to start with the steps in preparation of receipts and payments account in the next class. It's very interesting, children. Please stay focused and learn. Students, owing to time slot, I need to close the session today. I wish that we all stay safe, protected, and motivated. God bless us. Let's have blessed days to come. Thank you. Thank you.